Now, Asia's economic recovery is stalling, with two of the continent's manufacturing giants reporting slowdowns in production. In Japan, factory output shrank 1% in December. That's the first dip in 3 months as the global shortage in semiconductor chips continued to weigh on the nation's gadget and car makers. Meanwhile, in China, the manufacturing sector grew less than expected in January, with the industry's Purchasing Managers Index declining to 50.1 points. That's down from 50.3 in December and barely over the threshold that separates expansion from contraction. Profits also grew at their slowest pace in a year and a half due to the rising cost of raw materials and slowing demand. But officials in Beijing remain optimistic.
Of the 21 major industries, 19 are in the expansion range. The index for general equipment, cars and electrical machinery, and equipment industries are in the high range of over 60 points.
Now, for more on the story, let's go to Naeem Aslam. He's the chief market analyst at AvaTrade in London. Welcome back to the program, Naeem. Now, these numbers and reports like this have been the backdrop of this broader correction in markets that we've seen since the start of the year. How much worse can it go, or is this just a minor bump to possibly a good year for markets?
Sure, thank you for having me. I think this particular year hasn't been what traders were expecting, but smart money was certainly expecting that. Why? Because we are looking at an environment which is indicating or which is pointing to something which we have seen back in 2014 and 15, and that is a hawkish monetary policy stance by central banks around the globe, or the winding down of the asset purchase program. So whenever we have the absence of the extra liquidity out of the system, we do see a bumpy ride for the equity markets and also for the economic data. And that is what we are witnessing in the market now.
Right. Can we go in the opposite direction now of oil prices? The international benchmark Brent hitting $90 a barrel for the first time in 7 years, and that's feeding into higher inflation in major economies. But which industries are feeling this pain the most?
I think every single industry is really feeling the pain because of that, because there are arguments out there which many traders are making that, okay, yes, the Federal Reserve, i.e. the central bank in the United States, wants to control inflation by increasing interest rate, but does the Fed really have the ability to control inflation, especially when inflation is driven by two different factors? And one of them is, as you've pointed out, higher oil prices, and secondly is supply chain issues, which have been due to Omicron.
Right. Talking about inflation now, and one of the hedges to inflation that was really hyped up, especially last year, were cryptocurrencies. But we're seeing that fall in the past few weeks. They've sort of tracked prices of tech stocks more than that of gold, which is the traditional safe haven. So if it's not a hedge to inflation, what is Bitcoin or Ether in particular? What is it really?
Thanks. So that's an excellent question. Look, Bitcoin is still definitely considered as a hedge to inflation. And if you look at the price of Bitcoin or gold over the last number of years, you don't have to zoom in, you have to zoom out to see that particular trend. And the trend that you are particularly referring to is a very short-term divergence between gold price and asset prices of equity market. Right now, we do have that positive correlation, meaning when the markets are falling, Bitcoin is also falling, which mainly because investors are considering that as a slightly riskier asset. But that doesn't really mean to say that Bitcoin isn't considered as an inflation hedge. Look at the price over the last 3 years to 5 years or even 10 years, and you can clearly see how many Bitcoins how Bitcoin is still serving as a perfect hedge against inflation, just like how gold is.
All right, some hope for Bitcoin investors. Naeem Aslam, Chief Market Analyst at AvaTrade in London. Thank you for the analysis as always.